Welcome back to the Deep Dive. We are cutting through the noise today, going straight into the source material you shared with us.
That's right.
And today we're tackling, well, one of the most talked about, maybe polarizing tickers we cover. Tilray Brands, Inc., TLRY.
I know TLRY.
You're doing a fundamental analysis, trying to figure out if this, cannabis pioneer is really making that pivot into a stable CPG company.
Or if it's still just fundamentally a high-risk bet on regulations changing.
Exactly. Is it a successful transformation or still just a gamble?
And that's the core conflict, isn't it? It's fascinating. Can a company basically built on, let's face it, regulatory volatility, can it actually become a stable, diversified consumer goods business?
And that recent profit, was it real?
Right, that tiny flicker of headline net profit, does that mean the strategy's working? Or, was it just a one-off, an anomaly in the numbers? That's what we really need to dig into.
Okay, so just to frame this for everyone listening, we're looking at long-term value. Our analysis is locked in as of market close, October 9th, 2025. And on that day, the stock, TLRY, closed at $2.10 a share.
And here's where it gets, really interesting. Our fundamental models, the conservative ones that really factor in the risk here, they put the intrinsic value somewhere around $1.10 per share.
Wow, okay, big difference.
Huge difference. The market's paying $2.10. That's what, an 80% premium over our fundamental estimate?
So the big question is why?
Exactly. We're going to unpack all the data, try to figure out why the market is willing to pay that premium. Is it based on the actual business, the growth, or is it, like you said, just a massive bet on politics finally going their way?
All right. Before we jump into the details, just a quick reminder for you listening. Please hit like and subscribe to Stock Analytics AI. It really helps us keep doing these deep dives.
It does, yeah.
Okay, let's get into it. The business itself, we've set the stage. Time for Chapter 1, Business Analysis.
Okay.
Tilray is making it very clear, right? They're not just a cannabis company anymore. They see themselves as a diversified CPG player. Aggressively diversified.
That diversification strategy is absolutely the foundation of, any bull case right now. If you look at Q1 fiscal 26, their revenue breakdown really shows how they've spread things out.
And surprisingly, cannabis isn't even the biggest piece anymore.
No, it isn't. The biggest segment is actually distribution. That brought in $74 million, about 35% of their revenue.
Okay, what's that involve?
That's mostly their German subsidiary, CC Pharma. They distribute pharmaceuticals to 13,000 pharmacies across Germany. It's stable revenue, maybe lower margin, but it's consistent, provides a floor.
Okay. And then the original core, Cannabis.
That's number 2. Came in at $64.5 million, so just under 31% of revenue. They're still number 1 in Canada, market share around 9.4%, and they have a strong position in European medical cannabis. Think Germany, Portugal.
And the third pillar, acquisitions have been key there, right?
Definitely. Beverage Alcohol. That was $55.7 million, about 26.6%. Built up through buying brands like Sweetwater, Shock Top. They're now a top 5 craft brewer in the U.S. because of those deals.
Right. And the smallest piece?
That's wellness. $15.2 million, just over 7%. That's primarily their Manitoba Harvest brand, hemp foods, CBD products. Small, but it fits the CPG profile.
Now, here's the part that I find really intriguing. Connecting that beverage alcohol segment back to the cannabis plan. Analysts often call it the Trojan horse strategy.
That's exactly what it is. I mean, that U.S. beverage business, it's federally legal now. It's not just about selling beer today.
It's about infrastructure.
Precisely. It's a ready-made, functioning distribution network. They've got the brands, the logistics, the relationships with distributors, the shelf space.
All ready to flip to THC drinks?
The moment it's federally permissible, whether that's full legalization or, more likely in the near term, significant rescheduling, they don't have to build it from scratch when the time comes. It's already there.
Okay, so if that's the core strategy, then the entire investment thesis really hinges on regulatory change happening. What's the specific change they're waiting for?
The big one, the absolute game changer for the whole industry, would be rescheduling cannabis from Schedule I down to Schedule III under the Controlled Substances Act.
Not full legalization, but still huge.
It's huge because it would eliminate the Section 280E tax provision. That provision is crippling. Right now, cannabis companies often can't deduct normal business expenses, so they end up paying taxes on gross profits, not net. It makes sustained operational profitability almost impossible.
Ah, okay. So getting rid of 280E would finally allow them, potentially, to show real operating profits from their cannabis segment.
Exactly. Clears a massive hurdle.
That makes sense, and it really sets the stage for the financials. But first, let's look at who's steering the ship. Chapter 2. Management evaluation. This kind of roll-up strategy, buying and integrating companies, it really depends on the leadership.
It does. And the key figure here is the CEO, Irwin D. Simon. You have to look at his background. He spent, 30 years building the Hain Celestial Group?
Right, the natural and organic food company.
Yeah, and he built it using exactly this playbook, the roll-up strategy, acquiring diverse consumer brands, integrating them, finding synergies. He's trying to do the same thing here at Tilray, just in different verticals.
And we saw that playbook quite clearly with that big move in August 2023, didn't we? Buying those 8 beer and beverage brands from Anheuser-Busch for $85 million.
Yep. That wasn't just about buying beer brands for their current cash flow. That was explicitly about acquiring that strategic U.S. infrastructure, that distribution network we were just talking about. It was a strategic move, not just financial.
Okay, but when you evaluate management, you look at the strategy, but also the results, right? And here things get complicated.
Very complicated, because you have these conflicting signals. On the one hand, look at insider actions. Confidence seems high. In the last 6 months, CEO Simon himself bought 165,000 shares on the open market. There have been 3 insider buys total and 0 insider sales.
That usually sends a strong positive signal. Insiders buying their own stock.
It absolutely does. It suggests they believe the strategy is working, or at least will work. But then you look at the hard financial metrics generated by that strategy so far.
And it's not pretty.
Not yet. The key metric here is return on invested capital, ROIC. For the last 12 months, Tilray's ROIC is negative 3.3%.
Ouch. Explain ROIC quickly.
It basically measures how well a company is using its capital, both debt and equity, to generate profits. A positive number means it's creating value. A negative number, especially a persistently negative one like Tilray's had, means all that capital they've deployed, all those acquisitions, they've actually been destroying shareholder value up to this point.
So you have a CEO with a track record in roll-ups, insiders buying stock.
Yeah.
But the actual financial return on all that investment is negative. How do you square that circle?
Well, the argument would be, I suppose, that Simon's strategy takes time. And more importantly, it needs that regulatory environment, specifically the removal of 280E, to really bear fruit financially. They're absorbing the costs of building the CPG platform now.
But they can't fully monetize it yet because of the regulations.
That seems to be the bet. It's a waiting game, essentially. And they're funding that wait with equity, which brings us to the balance sheet later. We also can't ignore the governance side. There's an ongoing shareholder derivative lawsuit.
Oh, right. What's that about?
It alleges the current board didn't act quickly enough against the former leadership team regarding some alleged misconduct. It's definitely a distraction and raises some governance questions.
Okay, a lot to unpack there on management. Let's pivot to the numbers themselves. Chapter 3, financial analysis. This is where we try to see if that flicker of profit was, real sustainable progress.
Right. And you have to look at it against the backdrop of history. Historically, Tilray has just bled red ink. Years of net losses. The 5-year average annual loss compounded at something like 31%, just huge losses.
So against that history, seeing any profit must have seemed significant.
Exactly. When Q1 fiscal 26 results came out showing a headline net profit of $1.5 million, tiny. Yes, a 0.7% net margin, but still black ink. It definitely got attention.
But there was an immediate catch, wasn't there?
There was. You had to look deeper than the headline. That profit wasn't purely from operations. It was significantly helped by a $15 million non-cash gain. It related to contingent consideration, basically an accounting adjustment.
So strip that out, and they were likely still losing money operationally.
Probably, yes. So while it's maybe a step towards break-even, they aren't quite there yet on a sustainable operational basis. The headline was a bit misleading.
Okay, so if profitability is still questionable, let's look at their ability to survive this waiting game you mentioned. How strong is their financial foundation, their balance sheet?
This, I think, is genuinely the company's most significant strength right now. Their balance sheet is actually quite conservative, surprisingly so for the sector.
How so?
Look at the debt-to-equity ratio. It's incredibly low, just 0.17. That means they finance themselves primarily with equity, not debt. Very little leverage risk compared to peers.
And liquidity. Can they pay their bills?
Absolutely. Their current ratio is exceptionally strong at 2.46. That means they have almost $2.50 in short-term assets for every $1 in short-term liabilities. Ample liquidity.
So they have the financial runway to keep operating, even at a loss for quite some time.
Definitely. They can outlast many rivals who are saddled with debt or burning cash faster. This strong balance sheet gives them strategic staying power in this tough regulatory environment.
Okay, that's crucial context. Now let's talk valuation again. If profitability is inconsistent, PE ratio is meaningless. What about price to sales?
Right. PE is useless here. Price to sales, PS, is currently around 2.8x. And, compared to some cannabis peers that have traded at 10x sales or even higher in hype cycles, 2.8x might look attractive on a relative basis.
But relative isn't absolute. What about the fundamental value based on cash flows?
That's where we get back to the discounted cash flow, the DCF model. We try to project their future free cash flows, assuming they eventually do become profitable, and discount those flows back to today's value.
And that's where the $1.18 number comes from. Why such a low value compared to the $2.10 market price? Is it the discount rate?
It's largely the discount rate, yes. Given the immense uncertainty, regulatory risk, execution risk on the CPG pivot, future competition, you have to use a very high discount rate to reflect that risk. We're talking 12%, 15%, maybe even higher.
Because the future cash flows are so uncertain.
Highly uncertain. When you apply that appropriate risk premium via the discount rate, the math just doesn't support the current $2.10 price based on fundamentals alone. It points much lower, around that $1.18 mark.
Okay. So fundamental models and professional analysts seem aligned around that lower value. Let's shift to Chapter 4. Market sentiment. How is the market apparently ignoring this?
Well, the analyst community certainly isn't ignoring it. The consensus rating among analysts covering the stock is basically a cautious hold,
No buy.
not a buy, and their average 12-month price target, it's around $1.11. That implies they see, almost 50% downside from the current $2.10. So analysts are aligned with the fundamental view.
Which begs the question again. Why is the market price double that? It seems purely driven by sentiment, by hope.
It really does seem that way. The stock price appears completely detached from current fundamentals and analyst targets. It seems to react almost entirely to, news flow and speculation about regulatory changes. A positive comment from a politician or rumor about rescheduling.
And the stock spikes.
Exactly. And you can see that speculative fervor in some market indicators. Look at the short interest. It's really high, 14.06% of the public float.
Meaning a lot of traders are betting against the stock.
A significant number. But that also creates the potential for a massive short squeeze if any genuinely positive news hits, forcing those short sellers to buy back shares and driving the price up rapidly, independent of fundamentals.
And the technical chart pattern, does that show value buying or something else?
It screams momentum trading. The price, as of our analysis date, was trading way above its key moving averages, over 74% above the 50-day average, over 150% above the 200-day average.
So are traders jumping on board because the price is going up?
Pretty much. It signals a strong bullish technical trend, but one driven by momentum traders and short-term sentiment, not long-term value investors buying based on fundamentals.
Okay, if it's sentiment and momentum, let's look at who's actually doing the trading. Chapter 5, ownership structure. Who owns TLRY?
And the ownership structure really tells the story of why it's so volatile. The key finding here is that institutional ownership is remarkably low.
Really? Big funds aren't holding it?
Not significantly. Estimates put institutional ownership somewhere between only 9% and 12%. The vast majority, around 91%, is held by retail investors and other non-institutional entities.
Wow. That's heavily retail dominated.
Extremely. And what's even more telling is which institutions are holding the small slice they do own.
It's not the usual long-term value funds.
No. The largest institutional holders are typically passive index ETFs, which have to hold it if it's in their index and high-frequency trading firms. Think Citadel, Susquehanna.
Firms that thrive on volatility, not necessarily long-term conviction.
Exactly. Their business model is often based on capturing small price movements, providing liquidity, maybe arbitrage. They aren't necessarily making a long-term bet on Tilray's CPG strategy. This lack of a strong long-term institutional anchor means the stock price is easily swayed by retail sentiment, news headlines, and momentum, hence the wild swings.
That makes perfect sense.
Okay.
Let's try to summarize the key factors with a quick SWOT analysis. Chapter 6, risk assessment. Strengths, weaknesses, opportunities, threats.
Okay, internally, the core strength is definitely that balance sheet. Low debt, plenty of liquidity that gives them resilience, and, their existing market leadership, #1 in Canada, strong in Europe.
And the internal weakness.
Still the persistent lack of profitability. That negative ROIC is a major red flag about past capital allocation. And we've also seen some gross margin compression recently, even in their core segments, which is a concern.
Okay, now externally. The big opportunity seems obvious.
U.S. regulatory reform, full stop. Specifically, getting cannabis moved to Schedule III is the single biggest potential catalyst. The entire Trojan horse's strategy is built around capitalizing on that opportunity when or if it happens.
And the flip side, the major external threat.
Competition, but specifically the competition that would likely arrive after full U.S. legalization. If the doors swing wide open, you could see giant established CPG companies, big alcohol players, maybe even tobacco companies jump in with massive resources.
And they could potentially crush smaller players like Tilray, even with its head start.
They could certainly put immense pressure on margins and market share. Tilray's current scale might not be enough to fend off true global giants in a fully legal, competitive landscape. That's the long-term threat if the opportunity materializes.
Okay, that brings us to the end. Chapter 7, Conclusion. Let's synthesize the bull and bear arguments one last time for everyone.
Sure. The bull case, in a nutshell, rests on 3 pillars. First, the strategic pivot to diversified CPG, led by an experienced CEO. Second, the strong balance sheet providing the financial stability to execute that strategy and wait out the regulatory uncertainty. And third, the potentially massive asymmetric upside if U.S. regulatory reform, like Schedule III, actually happens.
Okay, and the bear case.
The bear case highlights the long history of destroying shareholder value, evidenced by that negative ROIC. It points out that the current stock price seems completely detached from fundamentals, driven by speculation and hope pinned on political outcomes. And fundamentally, it argues the current valuation around $2.10 is already stretched maybe 80% beyond a reasonable intrinsic value estimate, like $1.18.
So pulling it all together, what's the key takeaway for you, the listener, considering an investment in Tilray today at $2.10?
I think the takeaway is clarity. An investment in TLRY at this price is not a traditional value investment. It's not supported by current earnings, cash flows, or, frankly, conservative valuations.
It's something else entirely.
It's a highly speculative bet. It's a direct wager that favorable political and regulatory changes are coming, and coming soon enough, and will be significant enough to transform the company's economics and justify that premium price. It's almost a binary outcome based on factors largely outside the company's control.
So here's the final provocative thought to leave you with. We know Tilray's strong balance sheet gives it the financial runway to survive this political waiting game, perhaps for years. But is the gamble that U.S. politics will eventually resolve in their favor worth paying almost double what the fundamental analysis suggests the business itself is worth today? That's the core question.
Okay.
As always, a reminder, you can get access to our library of over 500 deep dive videos covering all the S&P 500 stocks for just €4.99 a month on Stock Analytics AI.
Great value.
And coming up next, exclusively for our members, we are tackling the NASDAQ 100. Plus, members can request deep dives on specific stocks. Just drop the ticker in the comments section and we will get on it for you.
And finally, that essential disclaimer. Please remember, this analysis was generated by an AI system. It's intended for educational and informational purposes only. It is absolutely not financial advice.
That's right. Please do your own thorough research, consider your own circumstances, and maybe consult with a qualified financial advisor before making any investment decisions.